Hi, my name's Aaron Andrew, and today I'm going to be talking to you about how life insurance, specifically indexed universal life, can be used in retirement as a tax-free vehicle to be able to generate income tax-free under certain sections of the tax code, and can be very safe, protected, and with a real low cost over the life of the policy. So we're going to go over those details a little bit, okay? So first of all, we need to understand where these things came from. So back in the early 80s, E.F. Hutton came to the insurance companies, okay, a stock brokerage firm, E.F. Hutton came to them and said, hey, you guys, you're a trillion-dollar industry. You're the backbone of the economy. Your legal reserve requirements are much higher than banks and credit unions. And you guys, under the sections of the code, we know that under these sections of the code, cash value inside of life insurance grows tax deferred under Section 72E. Under Section 7702, you can access your gains tax-free via tax-free policy loans, zero-cost loans that we talk about in another YouTube video you could watch. And then also under Section 101A, the death benefit transfers tax-free. So they said, wow, this, under the umbrella of a life insurance policy, you can have money in this policy. It can be growing tax-deferred, access tax-free, and transfer tax-free to my heirs. So he said, why don't we create a policy that people can put money into these, and the cash value, the money can be invested where you invest your money, insurance companies, in very safe vehicles, earning a good rate of return. And you guys have been around since the 1800s, very high-rated companies. So they said, let's create this kind of policy. So they did. All right, but people were taking, let's just use an example of $500,000. You could have whatever amount of money, but let's say $500,000. You put 500 grand into this insurance policy, and you go out and buy a little $50,000 death benefit. So that's what was happening back in the early 80s, is people were buying a little $50,000 dinky policy to put in $500,000. And they were getting all these tax advantages by having this little policy. So the IRS came along and said, hold on, you guys cannot do this. And E.F. Hutton and the insurance company said, yes, we can. So they took him to court. And so in court, guess who won? You would think the IRS would win, but no, they didn't. E.F. Hutton and the insurance companies won the battle because they were abiding by the tax code. They're big boys and girls. They have, attorneys. They know what they're doing. So they were abiding by the tax code. So the IRS went back and said, all right, we got to change a few things here. So they said, we want people to still be able to do this, because insurance companies want them to be strong and healthy. They're the backbone of the economy. But we need to make it more legitimate. So what they did is they came out. I'm going to use an example of a bucket here to kind of give you an idea of how this works, okay? So using the analogy of a bucket, if someone wants to put in $500,000, well, you can't just buy a $50,000 death benefit now to get all the tax advantages. Now, by the way, people that had policies before they came out with these laws I'm going to talk about, they're grandfathered. They don't have to abide by these new tax codes, okay? But these tax codes, the TEFRA, DEFRA, and TAMRA that came out in 1982, 1984, and 1988 are the ones I'm going to talk about right now. So TEFRA and DEFRA of 82 and 84 came out to say, all right, the IRS says, if you want to put in $500,000, depending upon your age and gender, we have to buy a certain amount of insurance. So if you're 60, you have to buy around $1.25 million of life insurance to put in $500,000. All right? And there has to be a need and a want for the death benefit, by the way, to make this all legitimate. So we have to say, okay, there's a need and a want and a desire for the death benefit, and then all this cash value is going to be growing tax deferred, and you can access it tax-free in retirement for tax-free income, okay? So this $1.5 million of death benefit, we have to put in $500,000. Now, what if you're 30 and you opened up a policy and you wanted to put in $500,000? Your death benefit would have to be around $6 million to put in $500,000, all right? So it's all depending upon your age and gender. The cost of the insurance is pretty close to the same for the 30-year-old as it is the 60-year-old. It's just that the 60-year-old gets $1.25 million of life insurance, and the 30-year-old gets $6 million, all right? And so we show our clients that one-on-one if you meet with us, and it's very important to get this done by someone that knows what they're doing, because this is complicated to do, but we do it all the time as far as getting the right amount of insurance to make this all work correctly under the tax code, because you want to be in compliance with these tax codes. So the TEFRA laws came out to say, all right, this much insurance for this much cash going into it. Now, if you wanted to put in $250,000, your death benefit would be half as much. All right, so it's all directly related to how much you're putting in. So let's talk about the next law, the TAMRA law. Well, the TAMRA law came out because let's say you have this $500,000 in the bank, and you go to the bank and say, I want to take out my $500,000, and they say, well, wait a second, Mr. Client, where are you going to put that money? Why are you taking it out of us? We were enjoying paying you 1 or 2%, okay? So they said, the client would say, well, I'm going to put it over to an insurance company. Well, why? Well, first of all, on average, they're about 8 notches higher on the rating scale than you guys are. These companies have been around since the 1800s. And by the way, in 2008, and 2009, 2011, up to 2012, and as far as we know, there hasn't been a single life insurance company that's gone out of business. There's been a couple that were going to go out of business, and they were just bought by another big company. How many banks have gone out of business? Over 300 plus banks have gone out of business with this recent recession that we've been in, okay? So the insurance companies are way stronger and higher rated and been around, all the ones we use have been around since the 1800s, since 1847, 1868, 1880, 1906 is how long these companies have been around. So way stronger institution, first of all. Now, number 2 is the money is growing tax deferred, and you can access the gains tax-free. The return was much higher, and if you pass away, you get this death benefit to your family. So because of all those benefits, it was much better than having your money in the bank or other financial institutions. So these other institutions like banks and other institutions lobbied Congress to pass the TAMRA law of 1988, and the TAMRA law came out, and guess what that one stands for? It stands for the Technical and Miscellaneous Revenue Act of 1988. Doesn't that sound like the government? So that law came out to say that you cannot put all the money in at once. If you want all these tax advantages, meaning the tax-deferred growth, but, they still get tax-deferred growth if you violate this law, but to get it out tax-free under Section 7702, you have to comply with TAMRA, which means you cannot put all the money in at once. You have to stretch it out over 5 years. So what the banks and other financial institutions were doing is they were trying to slow down the amount of money that was being transferred from their accounts into life insurance because they couldn't compete with it. Okay, so TAMRA came out, so we need to comply with TAMRA if we want it to be tax-free on the back end, which most of our clients do because that's one of the neat reasons of using these policies. So the fastest you can fund an insurance contract is about 4 years if you're under 40. If you're up to about 50, then it takes about 5 years up to about 55 to 58. Above that age, sometimes it takes about 6 years to fill up an insurance policy. Just depends on your age, okay? Also, sometimes it works better to fill up a policy over 10 years. So sometimes you meet with us, it's better to fill up a policy over 10 years with an increasing death benefit. Just kind of depends, all right? So what we want to see now is just going over to review this is we have a bucket. When you decide, I want to do this strategy, there has to be a need and a want for the death benefit, first of all. Number 2 is when you want to decide how much money do we want to put into this. Is it $50,000? Is it $100,000? Is it, $500 to $1,000 a month? It can be any of those figures. And then under the TEFRA laws, you need to comply with those to say, what's the least amount of insurance I can get away with at my age to turn this thing into a cash cow versus having a lot of costs going out in fees? Because that's how most life insurance policies are structured. So we want to get this spigot on the bucket, using this analogy of a bucket. We want to get the insurance, mortality, and expense charges that have to be there. I want to get those down to a minimum. So again, I like that spigot to be there. I like the cost of insurance to be there because I'd rather be paying costs of insurance to have a death benefit for my family versus paying taxes to Uncle Sam. Okay, that's this whole benefit of this life insurance contract. I'm going to show you how if we average about 8% in these insurance policies, over the life of the policy, there's about 1% that drains out for the fees and expenses. So we're netting about 7% tax-free. Well, I'd rather pay that 1% to the insurance company and getting the whole rest of the 7% tax-free versus paying 3 or 4% to Uncle Sam in taxes if I chose to leave my money in the bank or in the market or brokerage account. That's the power of life insurance. So especially the higher the tax bracket you're in, the better it's going to look, okay?
I've got it on the PowerPoint, so you're okay, stay there. Say, plus the incredible advantages of indexing, which is something we explained in another video.
Okay,
Like
yeah.
ready? Go.
Plus the advantages of indexing, which is another video. So you need to make sure you look at some of our other videos. We've got a great one that talks about this indexing strategy, how these policies can earn an average of about 7 to 9% historically, but we can earn as high as 14, 15, even 17 or 20% in some policies. and we have a guarantee each year of 0 to 2% in others, so we can't lose. So on average, our clients earn 7 to 9% even this last 10-year period that has been, a pretty bad economy, okay? So we've been able to average 7%. But that's another video, so make sure you look at our other YouTube videos, the indexing video, okay? The power of indexing. Now, let's talk about the life insurance policy some more here. So basically, going over this next slide, just to give you kind of a summary, if we had someone that wanted to put in $500,000 and they're 60 years old, a male, we're going to say, okay, the minimum amount of insurance is $1.25 million to put in $500,000. Now again, if they wanted to put in $1 million, the death benefit would be $2.5 million. Or they could put in $100,000 and it would be proportional, okay? Now the minimum might be $500 to $1,000 a month. The maximum is about $100,000 a year, or $500,000 total. Now those sections of the code is what allows all this to be tax-free, okay? And then here's all these wonderful advantages of the insurance contract. But I'm going to go to the next slide and use an example of helping you understand how this works. Because the government has put these restrictions, the TEFR, DEFR, and TAMR on us, and by the way, if you had a policy in the early 80s, it's grandfathered. You don't have to comply with those tax codes, all right? So that's the neat thing about the grandfathering with these policies. If they ever did change any tax codes going in the future, you should be grandfathered. Now, I can't guarantee that because, of course, but you don't know what the government's ever going to do, but you should be grandfathered. So with life insurance, with these, we like to use the example of a 5-story building. So again, if you want to put in $500,000, we have to buy $1.25 million of life insurance, and that $500,000, we can only put in $100,000 a year. So think about it this way. If you went out and bought a 5-story apartment building and the government's saying to you, all right, you guys can buy this 5-story apartment building and you're going to get some wonderful tax advantages for having this building. But there's a catch. We're not going to let you rent out all 5 floors at once if you want the tax advantages. You can rent out all 5 floors, but there's not going to be any tax-free access down the road. That's how the life insurance is. You can put in the full $500,000, but you can't access the income tax-free down the road. So if you want to comply, we can only rent out the first floor. If you bought a 5-story building and only rented out 1 floor and your other 4 floors are vacant, you're not covering your overhead yet. Okay, so you get me there? So you're not covering your overhead yet quite enough, so you got to be patient. This is not a get-rich-quick vehicle. It doesn't turn you into a millionaire in the first year. It takes a few years to get going. So the second year, you can rent out the next floor. And then the third year, the fourth year, and then in the 5th year, this thing is going to turn into a cash cow because you've got the thing fully rented out and you've got a lot of earnings and interest. That's how life insurance works. All right, we have to be patient for the first years. And we have other videos, too, that if you have all that money now, we have side buckets that you can put the money into that we talk about in other videos of where we can be earning interest with the money while it's not in the insurance policy. And that's another YouTube video we have. But let's move on, and let me show you a few examples of this. So I'm going to go here to the screen and show you an example of using a life insurance contract in this manner, okay? So as you can see here on the screen, we have got an example of, and by the way, this is a 65-year-old. So some of you say, oh, I'm too old, I can't use life insurance. We have a lot of clients in their 60s that use these plans, but this is a joint policy. So sometimes some people that are above age 60, we will use a joint policy, okay, what's called a second to die or survivorship policy. There's only a few companies that have these. And again, you don't want to use just any company. You need to come to the right firm like us or someone that's been referred to by us that knows how to do this strategy, because you have to use the right companies and the right product, okay? But this is 2 65-year-olds that are on a joint policy, so they pass on $1.5 million to their family when they pass away, okay? But nothing happens upon the first death, all right? But this can continue to generate tax-free income for them even if one of them passes away. So they're insured for $1.5 million, 2 65-year-olds. We're going to put in $100,000 a year for 5 years. So you see, the first year, we've rented out the first floor of the building, all right? At the end of the first year, there's $95,000 of cash value. Okay, so there's $95,000 of cash value. You can see that we're down about $5,000 after earnings and expenses. And the surrender value is our liquidity column if we were to cancel it, surrender it, walk away from it, or it's also an amount we can borrow. We can access withdrawals or loans 90% of that number without canceling the policy. Okay? And again, the death benefit is $1.5 million if they were to pass away. All right? So again, we use a joint policy because it's a lot cheaper, works really well for people that are above 60. Now, in 5 years, we have got $561,000 inside the cash value. So we put in $500,000. You can see the policy turns positive almost in the second year. The third year, it's got $309, then $430, $561, and the surrender value. So you see the accumulation and the surrender value in the 10th year equal each other. So that surrender charge is gone after 10 years, and the death benefit's 1.5. By the way, just real quick, I'm going to show you another example. Some policies have an other option. So look real quick on the screen. There's an option of no surrender charge. So it does add extra cost. So most clients don't opt to have this option. But if you need full liquidity to the policy, you can see this number's 95 and that number's 95. There's no surrender charge in this option. Okay, so there's different ways to do this, and that's why it's good to go to a firm that knows what they're doing and to find the right fit for you. But in this example, you can see that after 10 years, if you didn't touch this policy, it's going to grow to $792, and the cash value is going to continue to grow. Let me just explain one thing here. See, in year 13, they've got $1 million inside the insurance policy, and their death benefit's $1.5 million. So now, they've got $1 million of cash value earning interest, an average of 8% in this example. So that's $80,000 a year of tax-free interest, and their death benefit's $1.5 million. So how much insurance are they paying for now? They're only paying for $500,000 of insurance. So even though they're 13 years older, they're now, from 65 to 13 years, they're quite a bit older. Insurance gets more expensive as you get older, but actually in our policies, it gets cheaper because they're not paying for $1.5 million of life insurance. They're only paying for $500,000 of life insurance. And a lot of these policies have higher costs in the first 5 to 10 years, and those fees are all gone, so the policy gets super cheap after 10 years, and we're paying for less and less life insurance. So you look down here at year 18, you'll notice that the cash value is $1.4 million, almost $1.5. You see the death benefit starts to creep up. If you didn't take money out of it, you have to have the death benefit go up automatically to comply with the tax code. So if you never touched it, in 30 years, they've got $3.8 million in there, 3.89 in the death benefit. You can see there's hardly any life insurance. That's how life insurance should be used as a living benefit. You can access this money and the cost gets super cheap down the road, okay? Let's go over another example. Let me just show you an example of taking out income. By the way, over the life of this policy, just go over this quickly, the net return after all fees and expenses over the life of the policy is 7.5%. Our gross return was 8%. So if we grossed 8% and our net return was 7.5% after all fees and expenses, that's 0.45%. So I paid 0.45% in fees that paid for what? The commissions that paid for the death benefit for my family and all these tax-free advantages and allowed me to have high returns up to, in this policy, 14, 15% caps right now, an average of 8%. So those fees were about 0.5%. And you earn 7.5 net after all fees tax-free. To earn 7.5 in like a mutual fund or a taxable account, you'd have to be earning probably 10, 11, 12%, depending on your tax bracket, net after the fees to do what this does at 7.5. And by the way, if you watch the indexing video, we don't lose when the market goes down. We have a protection of principal guarantees from the insurance company, okay? So that's what's so neat about the policies, how cheap we can get them. People sometimes think life insurance is expensive. Not the way you do it if you do it this way, all right? Here's another example of income. And we don't have time to get into this a lot. This is another YouTube video that I've done that is on loans. So watch the tax-free, how to access your money tax-free via zero-cost loans. There's also an indexing one and an index loan feature and a variable loan feature, 3 different YouTubes we've done on that. But this example is showing the clients after 5 years, at age 70, starting to take out $50,000 a year tax-free to age 120. Okay? So, of course, they probably won't live to age 120, but the policies go to age 120. And you can see that the surrender value, as they're taking out $50,000, the cash value is still hovering around at $500,000. So again, you put in $500,000 over 5 years, it grew to $561. Under these loan features, that income is coming out tax-free It not just show up on your tax return, okay, and it's all legal in the tax code under what section? 7702. That this is all coming out tax-free. By age 95, it's actually grown to 1.1 million. If they passed away, they leave behind that much to their heirs, income tax-free. By age 100, it's actually grown to almost 2 million, and they took out $1.5 million tax-free over all those years. And you can do this in your 30s, 40s, 50s, 60s, even your 70s, you can do this strategy, okay? And another example here, just real quick if we got time, is we compare this to other alternatives. And so here's a quick example of saying, well, what if we put this same $100,000 a year into a CD at 4%, an annuity at 8%, and a mutual fund at 8%, IRA 401k at 8%, and the insurance policy at 8%, trying to compare apples to apples as much as possible. Also, having some fees in theirs. Here's some 1% management fees and some sales charges. Over here, we're showing net after taxes. We're showing a 30% tax bracket, marginal tax bracket, 25% federal, 5% state. They're looking at this in 5 years. You know, the first years they're going to outperform us. But in 5 years, we've caught up to them and we're at 561 and we have insurance and they don't. So you know that whole term, buy term invest, the difference? Well, if you had to buy term insurance with these other investments, they'd have even less in them. But as you take out $50,000 a year of tax-free income out of the insurance, the other investments you're having to take out more. So the insurance is a tax-free vehicle that generates the 50 grand. At the end here, they all run out of money. So by age 85, the annuity's out of money. The insurance still has $565,000 in it compared to the other vehicles. So this just shows you, it gives you a little taste of how insurance can be used in retirement planning as a tax-free alternative to be able to generate income tax-free and be able to have a very safe place to put your money, which has guarantees, which we can earn about a 7 to 8. So again, watch our other YouTube videos that talk about the indexing and talk about tax-free loans out of life insurance. Thank you for joining us today. To get more information, make sure you contact us at 888-987-5665. Or you can visit us online at missedfortune.com. That's MISSED, fortune.com. Thank you.